Yeah, I think we'll go ahead and get started in lieu of time here. Welcome to today's webinar, Understanding the DOL Proposed Investment Selection Rule, presented by Union Bank and Trust. Presenting today is, of course, John Nowns. John is a vice president and an ERISA attorney, as well as a relationship manager here in Retirement Plan Services at UBT. Before we get started, just a little bit of housekeeping here. We will leave time at the end for questions. So if you do have any questions, please hang on to those until the end. And if you utilize the chat box, which is great, we will get to those questions at the end as well. Also, John's contact information will be posted at the end of the webinar. And as always, feel free to reach out to your relationship manager with any follow-up questions that you may have. You may or may not have heard, but today's presentation is being recorded. And we will be including it in the quarterly plan sponsor email as well as posted to the website. And so when that becomes available, we will send out some notification letting you know where or when the presentation is available, and then of course where you can access it as well. Before I hand it over to John, excuse me one second. Before I hand it over to John, I'm just going to read this disclaimer. I'm certainly not going to read it verbatim, but I just want to let you know that the information that John is going to provide is intended for informational purposes only. Neither John nor UBT is providing any legal, tax, or financial advice, just education. And so that's all this disclaimer is saying. And so with that, I'm going to hand this over to John.
Thank you, Jason. And I echo Jason's comment about welcoming you to our client webinar about the new proposed rule issued by the Department of Labor with respect to investment selection inside a 401k plan. So we're going to talk about the presidential executive order of last year a bit that really set the stage for the DOL's proposed rule. We're going to talk most of the time about the rule itself, how the rule is structured, and then we're going to kind of close with what's next, both in terms of what the expectations are for when we might see a final rule, and also a discussion about whether it's whether 401k plan fiduciaries should be thinking about adding alternative assets to their investment lineup. And so first of all, the genesis of the Department of Labor rule occurred August 7th of last year. There was a presidential executive order titled Democratizing Access to Alternative Assets for 401k plan investors. And there were two primary purposes for the executive order. The first is that the Trump administration wants to allow 401k plan participants to have greater access to alternative assets. The second primary purpose of the executive order is that the administration is concerned about the litigation risk that may have a chilling effect on 401k plan fiduciaries from offering alternative assets inside 401k plans. And so the underlying belief is that in the current litigation environment, that employers are wary of offering alternative assets inside of their 401k plans, even though alternative assets, according to the administration, could improve long-term retirement security for participants. And so we need to understand what we're talking about when the presidential executive order talks about introducing alternative assets into 401k plans. And first of all, right off the bat, there has never been a prohibition with respect to adding alternative assets inside of 401k plans. It's just that this administration thinks there's a place for alternative assets in 401k plans, and they want the DOL to explore that possibility to make them more widespread available inside 401k plans. So there's a bunch of different types of alternative assets, but when you read articles about the proposed rule, alternative assets really, for the most part, we should be thinking about private equity, private debt, and maybe a little bit digital assets, cryptocurrency. So even though there's a bunch of different categories of alternative assets pursuant to the presidential executive order, really you should be thinking primarily about private debt and private equity getting inside of 401k plans. And so Uh, the president had three directives to the Department of Labor, and the first is to clarify the position on alternative assets and what the fiduciary process would look like if the fiduciary wants to add asset allocation funds that include an alternative assets component. And so, look at this. There's been, I think, some misconception that the administration has been saying, oh, that standalone private equity funds should be inside 401k plans. And that may be their position, but this presidential executive order is much narrower than that. And it really talks about asset allocation funds that include an alternative assets component, right? So asset allocation funds, simplicity purposes, it's really a fund where there's diversified assets across various asset classes, such as publicly traded stocks and bonds, and maybe with a component of private securities in there. The second directive to the Department of Labor is we can generally acknowledge that alternative assets typically have higher fees and expenses when compared to publicly traded mutual funds. And so what the presidential executive order tells the DOL to do is to identify how 401k plan fiduciaries can balance this concept of higher expenses of alternative assets against the goal of seeking a higher long-term return and broader diversification. Again, the idea is, according to the administration, that private equity can offer broader diversification opportunities for 401k plan investors. And then the final directive to the Department of Labor, we touched on it, is take some sort of action designed to hopefully curb litigation that has supposedly had a chilling effect on 401k plan fiduciaries from offering alternative assets in 401k plans to begin with. So that was the genesis of the proposed rule. And in late March, the Department of Labor issued a proposed rule titled Fiduciary Duties in Selecting Designated Investment Alternatives. So, designated investment alternatives, or DIAs, that's typically the mutual funds that you, the employer, make available to your participants in a participant directed 401k plan or an ERISA 403b plan. And so the primary goal of the proposed rule is to alleviate the regulatory burdens, alleviate the litigation risk that has prevented workers from achieving higher returns and asset diversification within their 401k accounts. And the DOL cites three different principles to support that overarching primary goal. And the first is to affirm that ERISA is a law grounded in process. So ERISA is a process-based law. It's not an outcome-based law. And so all a fiduciary is required to do with respect to selecting a plan's designated investment alternatives is to follow a prudent process in selecting those DIAs in the plan. So as long as the fiduciary follows a prudent process, it doesn't really matter what the outcome of that process is. So if a fiduciary selects a fund and that fund turns into be a poor performing fund, ERISA doesn't really care as far as measuring the duty of prudence what the outcome of that fund was. It's whether the fiduciary followed a prudent decision-making process in offering that fund in there. Now, of course, participants, the Department of Labor, everybody cares if there's poor performing funds in a plan or high performing funds in plan. So in fact, if I'm a fiduciary and I happen to choose the 20 worst performing funds in the universe, it is highly doubtful that I followed a prudent process and just got really unlucky. But the point of the matter is we're measuring prudence based on the process a fiduciary follows, not on the outcome. The second principle is the Department of Labor wants to give fiduciaries the maximum discretion and flexibility to decide what designated investment alternatives should be in the plan, that permits participants to maximize their risk-adjusted returns net of fees, and that can include offering alternative assets inside the plan. And then the final principle supporting the overarching goal of the proposed rule is the Department of Labor asserts that when a fiduciary follows the safe harbor decision-making process that we're going to talk about in just a couple of minutes, that a plan fiduciary can be confident that it has satisfied the duty of prudence when it comes to selecting the plan's investments, and that when the fiduciary follows this safe harbor decision-making process in selecting the DIAs in the plan, that courts should defer to the fiduciary under a presumption of prudence. So, before we start talking about the proposed rule in some detail, just a bit of a fiduciary duties refresher. So, the duty to select the plan's investments usually falls on the plan sponsor, which is usually also the plan administrator, unless that duty has been specifically delegated to another fiduciary, for example, a plan committee, or maybe an ERISA 338 investment manager that we're going to talk about in a couple of minutes as well. So if I'm a fiduciary in a 401k plan, when I'm selecting the plan's investments, I have to satisfy the exclusive purpose rule that's also known as the duty of loyalty. I need to satisfy the prudent person rule as well as the diversification rule. So just to touch on the diversification rule and the exclusive purpose rule, first of all, that exclusive purpose rule, also, as I said, known as a duty of loyalty, when I select a plan's investments, I must make that selection based solely for the benefit of participants. So if I've got a brother who manages mutual funds and I decide, oh, I'm going to put my brother's funds inside the plan, I have violated that exclusive purpose rule because I didn't make the selection of those investments based on loyalty to participants. I did it because it was my brother running the funds. And we can't do that. We have to satisfy the exclusive purpose rule. We also have a diversification rule that we need to be aware of. And in overly simplified terms, it's really we need to put together an investment menu that allows participants to diversify their 401k accounts over a range of available investment options. The prudent person rule, however, this proposed rule really only deals with the prudent person rule. And so we need to kind of know what the prudent person rule is, and it's defined in ERISA rather than read the definition of the prudent person rule. I like to bottom line think about it as the fiduciary just needs to know what it's doing when it's selecting the plan's designated investment alternatives. And what that means is that the fiduciary needs to have the required expertise, skills, and knowledge to be able to evaluate a plan's investments and make decisions on what investments should be allowed inside the plan. And in fact, what ERISA requires is that if that fiduciary does not have that requisite skill, ability, and expertise in selecting the plan's investment alternatives, then it needs to hire an outside fiduciary to help satisfy that prudent person rule. The other thing that if you look at the preamble to the proposed rule, as well as the examples, the DOL is not very subtle when it comes to this fact. And the DOL is really pushing employers to outsource some or all of its fiduciary responsibility when it comes to selecting designated investment alternatives into plans. And so this outsourcing can take one of two flavors. The first is the ERISA 321 investment advisor. So if you hire a 321 investment advisor, that investment advisor will make recommendations with respect to investments that you're going to offer inside your 401k plan. So let's say I'm a 320 investment advisor and I'd say, I recommend you add this fund and I recommend that you remove this fund. And so that 321 investment advisor makes the recommendation, but it is that employer plan administrator that still retains the final decision making authority to select the plan's investment. So I'm an outside advisor, 321 advisor. I say, I recommend you put in this plan, or rather this fund in your plan. The employer slash plan administrator still has to either accept my recommendation or reject it. So that employer plan administrator still retains that final decision-making fiduciary authority with respect to the plan's designated investment alternatives. The second flavor of outside fiduciary help comes in the form of an ERISA 338 investment manager. And here, the employer plan administrator is really delegating all of its fiduciary responsibility to the 338 investment manager. And it is the 338 investment manager who actually selects those designated investment alternatives. So it is the 338 investment manager who has the responsibility, the duty, and the liability when it comes to selecting the plan's designated investment alternative. So if you are a Union Bank client and you're interested in learning more about Union Bank's 321 services and or 338 services, you should talk to your relationship manager. So here's what the Department of Labor wanted to get done, the approach that they took with this proposed rule. So we talked about that executive order focused on alternative assets, but what the DOL wanted to do was not just focus on alternative assets. In fact, what the Department of Labor's rule says is that alternative assets, or any type of investment for that matter, is not a favored investment or a disfavored investment. The proposed rule then takes an asset neutral approach to evaluate investments that you're going to put into your plan, and it provides a roadmap for fiduciaries to follow when it comes to evaluating and selecting the plan's investments in a prudent manner. And so this is a different approach from the Biden administration, who back in 2022 had a compliance assistance release, sub-regulatory guidance that came out and said, talking about putting cryptocurrencies inside of 401k plans. The Biden administration says that there are serious concerns that that administration had with adding crypto to 401k plans, and that fiduciaries should use extreme caution in adding crypto to 401k plans. Now, that may be accurate in the sense that maybe fiduciaries should use extreme caution when adding crypto, but what this proposed rule does, it puts all assets on the same footing. You look at an asset, an investment, and you decide whether it's appropriate or not to put into your plan after a thorough evaluation of the relevant factors in deciding whether to put an investment inside your plan. So it's an asset neutral approach, and it goes beyond alternative assets. And we're going to see how that's going to work in a moment. So what the Department of Labor does is it takes a non-exhaustive list of 6 factors for a fiduciary to objectively, thoroughly, and analytically consider and make a determination on those factors for each investment that you're going to consider. I underline that, objectively, thoroughly, and analytically consider, because it occurs throughout, especially the preamble to the regulation. And so what we're going to want to do as a fiduciary is we're going to have to objectively, thoroughly, and analytically consider those 6 factors with respect to the investments that we're going to consider when making a decision which investments we're going to put into our plan. And so when the fiduciary follows this safe harbor approach, its decision to add a fund to the plan is presumed to be reasonable and is entitled to significant deference in courts. And so even though the DOL postures this rule as a safe harbor, it really isn't a true safe harbor, right? If you've got a safe harbor, basically what it says is, I follow these rules, it all will work out in the end. Well, it's really not a true safe harbor in that respect, because look at that language. The fiduciary's decision is presumed to be reasonable, but there can always be, and that's really a rebuttable presumption in the sense that if someone comes out and says, yeah, but it really wasn't reasonable, then that really isn't a true safe harbor. So that's something we need to be aware of. Um, well, the majority of the regulation focuses on selecting a designated investment alternative for the plan. We also have similar concepts with respect to that bottom bullet point. There's also a fiduciary duty to monitor the plan's designated investment alternatives, and the Department of Labor acknowledges this, but doesn't really address it inside the proposed rule. Commentators have said that you really should talk a little bit more about the duty to monitor designated alternatives, because I may select this specific mutual fund in my investment lineup, and if I don't look at it for another 20 years, well, I don't think that's prudent. I should be monitoring those designated investment alternatives. I can't just put it in my plan and kind of ignore it. And the practitioners have hoped that the Department of Labor will expand on this concept of monitoring designated investment alternatives. The proposed rule also touches on a bit on the duty to establish an investment menu to maximize risk-adjusted returns. And so that's similar, but it's different than what we're talking about here, right? Is this rule is really focused on the steps a fiduciary needs to take when evaluating individual designated investment alternatives. But as part of this, in the broader scope, there is this duty to establish the investment menu as a whole to be able to maximize risk-adjusted returns net of fees. The proposed rule touches on it a bit, but practitioners say that they want the DOL in the final rule to go into a little bit more detail, put a little meat on the bones with respect to this duty to prudently establish the investment menu as a whole with respect to 401k plans. So the structure of the proposed rule is that, I mentioned, is that the Department of Labor lists 6 different factors that should be considered if that specific factor is relevant to the investment that you're going to put inside your 401k plan. So what the Department of Labor rule does is takes a look at these factors and then gives examples of how fiduciaries can satisfy this performance factor. And so what the fiduciary needs to do is take a look at each of these factors and satisfy the duty of prudence with respect to each of the relevant factors. And we're not going to talk about details of the examples. There's 20 different examples in the proposed rule. We could easily take a couple of hours just picking apart those examples. And so what I'm going to do is give a brief introduction to each of the factors and some of the major takeaways from the examples. But obviously, we don't have time to go into deep detail about each of the factors in the examples. So the first factor is performance. And so to satisfy the prudence duty with respect to the performance factor is our fiduciary must consider a reasonable number of similar alternatives and determine that the risk-adjusted returns net of expenses are such to allow participants to maximize their risk-adjusted returns. So this concept of risk-adjusted returns in simplified terms is we're going to look at the expected return of investment and we're going to measure that against the risk that investors need to take in order to achieve that return. And so the proposed rule talks a lot about maximizing risk-adjusted return net of expenses. Some of the takeaways from the performance factor is that this means that the fiduciary doesn't necessarily focus solely on the expected returns, but must also consider the risk of investing in a specific designated investment alternative, the economic risk, market risk, sector risk, etc. And the fiduciary should consider the workforce demographics when determining an appropriate time horizon. With respect to a reasonable number of similar alternatives, there's no clear answer set forth in the proposed rule, but in the couple of examples that the Department of Labor uses, for example, we've got a fiduciary in the examples that is trying to decide what target date series of mutual funds we're going to put inside of our plan. The examples say that the fiduciary looks at 3 different target date series of funds, and the Department of Labor says that's sufficient for satisfying the duty of prudence with respect to the performance factor. Our fiduciary also doesn't necessarily have to seek the investment with the higher returns, but again, aim to maximize returns given an appropriate level of risk. And then finally, we've got an example where a fiduciary looks at a mutual fund's 1, 3, and 5-year performance data, and our fiduciary also looks at the 10-year performance data and gives more weight to the 10-year performance data because that fiduciary is determined that 10-year performance is more important than, for example, a 1, 3, or 5-year performance, given the long-term investment horizon that for a retirement plan. Next is fees. Again, our fiduciary needs to look at a reasonable number of similar alternatives, and with respect to fees, that fiduciary must determine that those expenses or fees are appropriate, again, in light of its expected risk-adjusted returns. A couple of takeaways from the fees factor examples is that a fiduciary doesn't necessarily violate its duty of prudence if the fiduciary doesn't select the designated investment alternative with the lowest fees. Fees should be analyzed in relation to their risk-adjusted returns. There's also an example where a mutual fund has several different share classes, and the fiduciary needs to understand the difference in the share classes with respect to fees. So most of the time, right, is that we've got a mutual fund with different share classes. The investments are the same in all those share classes, and the only material difference is in fees. And so if that's the case, then our fiduciary should be choosing the share class with the lowest fees to put in our plan. There's also an example in the proposed rule where a fiduciary ends up selecting a higher expense target date qualified default investment alternative, and it's a higher it's a higher expense target date fund because there's some alternative assets in that target date fund. And what our fiduciary did was weighed that higher expense against, in this case, this example, the fiduciary determined that for risk mitigation purposes, this target date QDIA with alternative assets inside of that QDIA provides real downside protection, and that justifies the fiduciary choosing this fund even though it has a higher expense ratio. There's another example there where the fiduciary decides it's going to offer 2 different designated investment alternatives in the same style box. Let's say we're looking at small cap growth funds, and our fiduciary decides it's going to offer one actively managed small cap growth fund with a higher expense ratio and one passively managed small cap growth fund that has a lower expense ratio. The Department of Labor says that this fiduciary concluded that offering two funds in the same style box, one with higher fees than the other, can provide potential diversification benefits to participants. And so this is perfectly appropriate for the fiduciary to do to satisfy its duty of prudence with respect to the fees factor. Liquidity factor. The fiduciary must make sure that any plan designated investment alternative will have enough liquidity to satisfy the needs of the plan as well as the needs of the participants. And the reason why this is important is because alternative assets often are much less liquid than publicly traded securities. And so there's an example in there that says, in the case of alternative assets, that there may be an illiquidity premium given to alternative assets investors. And this concept of the illiquidity premium, again, in simplified terms, is that our alternative assets, and let's say it's a private equity fund, investors, because their money in that private equity fund may be locked up for a specific period of time, will demand an incrementally higher return on that investment. And so what the example says is that the fiduciary took a look at the fund, determined that it's much more illiquid compared to a mutual fund, but our fiduciary, after evaluating the fund, decides that there's an illiquidity premium that offsets the illiquid nature of that fund and decides that it's appropriate to offer that fund inside the plan, because even though participants may sacrifice some liquidity, that there is a greater potential for a higher risk, a higher risk adjusted return. So some other takeaways from the fees factors when you look at the examples: liquidity is typically not an issue with publicly traded mutual funds. For private securities, private equity, for example, illiquidity can be a factor. And what the proposed rule does is, and they say this a couple times in the examples, that in order to satisfy its duty of prudence with respect to this factor, is because our plan fiduciary doesn't really have the expertise to evaluate these private securities, that there's a written representation, let's say, from the investments manager, and the investments manager provides this written representation to the plan fiduciary, talking about its risk, its liquidity risk management program. And what the fiduciary does is reads, understands that written representation. If it doesn't understand that written representation, then that fiduciary needs to hire outside help to help understand how liquidity works with respect to these private securities. And as long as our fiduciary either understands that written representation or gets outside help, in other words, delegates some or all of its liability and responsibility to select those designated alternatives, Department of Labor says that our fiduciary is going to be okay. Next is valuation. So a fiduciary must look at each investment it's going to put in the plan and determine that those assets are timely and accurately valued. So if you've got a publicly traded mutual fund and the underlying assets are all publicly traded stocks and bonds, well, we really don't have a valuation factor that we really need to consider that much, because the fiduciary can simply rely on those prices that are determined on a national securities exchange, because we know that that publicly traded mutual fund is going to be readily and accurately determined and valued. Now, if we have a fund that's got a private securities component to it, well, typically we're not going to be able to have that valued on a daily basis on a national securities exchange. And so what the example says that if you've got some private securities, again, we need some sort of assurance that those private securities are being accurately valued and timely valued. And in one example, the fiduciary relies on a written representation from the fund manager with respect to the fair valuation of those private securities in accordance with FASB 820, which is basically an accounting standard that defines fair value and provides a framework for measuring fair value of investments. The next is the performance benchmark factor. And so under this factor, the fiduciary must consider and determine that each designated investment alternative that we're going to put into our 401k plan has a meaningful benchmark. And we're going to have to compare the risk-adjusted expected returns of our DIA based on historical performance to a meaningful benchmark. And then finally, the proposed rule defines a meaningful benchmark as an investment strategy, index, or other comparator that has similar mandates, strategies, objectives, and risks that's similar to our designated investment alternative. So a couple of the takeaways here is we've got one example where the DIA is a target date fund. And as we know, target date funds shift their asset allocations over time. So the further away from our target date, our fund is going to be a little less conservative, more aggressive. It's going to have more stocks than bonds in it. The closer we get to the target retirement date, our target date fund becomes more conservative, which means less exposure to equity stocks and more bonds inside of our target date fund. Well, this fiduciary benchmarks its target date fund against a large cap stock fund. Well, the large cap stock fund has nothing in it but large cap stocks. And so the DOL says that is not a meaningful benchmark because it only has large cap stocks in it, and our target date fund has a different investment strategy and objective. It starts out more aggressive the further away from the target date we are, more stocks, less bonds. The closer we get to the target retirement date, the more conservative it becomes, less stocks, more bonds. A large cap stock fund is not a meaningful benchmark in this case. There's another example where we've got an asset allocation fund that has both a public securities component and a private securities component. Remember, we're talking about performance benchmarks here. The public securities, pretty easy, right? We can find pricing and stuff like that. And our fiduciary benchmarks the public securities component of the fund against a blended mix of stock and bond holdings in the same proportions held by our designated investment alternative, right? And so if our public securities portion of our fund is 60% stock, 40% bonds, our fiduciary looks at benchmarks that have 60% stock offerings and 40% bond offerings. With respect to the private securities component of our fund, there really isn't publicly available benchmarks readily available to us. And so in the example, we've got an investment advice fiduciary, that's a 321 fiduciary, that uses common valuation methodologies and provides a written explanation to our plan fiduciary as to the composite benchmark that that investment fiduciary used to be able to benchmark the private securities component of our fund with other investments. The fiduciary reviews and understands that written explanation, doesn't have any reason to doubt the validity of that explanation. And so the Department of Labor says that that fiduciary satisfied its duty of prudence with respect to the performance benchmark factor. First of all, with the public securities, no real problem there, but accepting and understanding that methodology, that valuation methodology used by our investment advice fiduciary. Next is a complexity factor. And what the Department of Labor says that when a fiduciary is looking at investments to include inside their plan, the fiduciary must consider the investment's complexity, and the fiduciary must determine that it has the skills, knowledge, and experience to be able to evaluate and understand the DIA's complexity. So takeaways from the examples, the DOL pretty much says in one example that if the fiduciary doesn't have the skills, knowledge, or expertise, experience to evaluate the complexity of a designated investment alternative, that fiduciary must hire a 321 investment advisor or a 338 investment manager to be able to satisfy the prudence standard with respect to the complexity factor. In another example, again, there's a specific written representation from the fund manager given to the fiduciary. The fiduciary reviews the written representation, understands the written representation, and has no reason to question the written representation. The Department of Labor says that's fine. Our fiduciary has satisfied its duty of prudence with respect to the complexity factors. So that's a real quick run through of the factors, again, a non-exhaustive list of factors that the Department of Labor says that plan fiduciaries must consider when determining what designated investment alternatives we're going to put inside of our 401k plan. So a couple of big picture observations of the proposed rule overall. And I think there's really two important observations. The first is that the proposed rule does not alter the fiduciary duty or the process that fiduciaries need to follow when it comes to selecting a plan's investments. In other words, the duty of prudence, that duty of loyalty, the diversification requirement all remain in effect. And really what the proposed rule attempts to do is to formalize or standardize what fiduciaries have always really been required to do when it comes to selecting the individual investments that they're going to make available to participants in their 401k plans. And so the prudent decision-making process has not changed at all. So you're going to want to follow these 4 steps regardless of whether you're going to put a cryptocurrency fund in the plan or you're just going to put an S&P 500 index fund inside your plan. And that's why this rule is an asset neutral rule. Fiduciaries should be taking these steps with respect to any investment it decides to put inside the plan. And that first step is that the fiduciary needs to decide which factors are relevant in evaluating investments. So if we've got publicly traded mutual funds in there, we're really not going to worry about things like valuation or complexity or liquidity. The relevant factors are going to be performance and fees and benchmarking and such like that. But whatever factors are relevant with respect to a specific investment, you need to evaluate each of those factors with respect to the investments that you're considering about putting into your plan. So after you decide which factors are relevant, the fiduciary needs to gather information about those relevant factors. Then the fiduciary must review and evaluate the gathered information about those relevant factors. And then finally, our fiduciary must make a decision. I'm going to put mutual fund XYZ inside of our 401k plan and document the reasons for that decision. In other words, for a publicly traded, we're going to, again, look at fees. We're going to look at performance and benchmark liquidity, complexity, valuation. We can certainly put in our notes when we document that these are really not relevant factors because they're traded on national exchange. Typically, mutual funds don't have liquidity issues, and certainly they're not super complex that we need to worry about that with respect to publicly traded mutual funds. The other observation, again, if you read this proposed rule, the preamble to the examples, as I said at the top of the presentation, the Department of Labor really wants planned fiduciaries to hire the services of a 321 investment manager or a 321 investment advisor or a 338 investment manager. Especially, it's required when the fiduciary just doesn't have the requisite expertise to evaluate and select a plan's 401k investments. The other important big takeaway observation about this rule is it doesn't require a fiduciary to add or even consider alternative assets. So you can read these articles and such and almost say, oh my gosh, I have to worry about the onslaught of alternative assets taking over my 401k plan. No, that's not the case. This is an asset neutral rule. And so that means if you're comfortable with publicly traded mutual funds and you don't want to add anything to your investment menu other than publicly traded mutual funds, you can do so. You just need to look at the relevant factors, evaluate them, and say, yep, it makes sense to put this fund in our plan. If you don't want to add or even consider alternative assets, you're not required to do so. So those are the two major observations that I take away from the proposed rule. And again, I think if you're thinking about adding alternative assets, you're certainly going to increase complexity. And I doubt there's many employers that have the expertise to be able to evaluate alternative assets, private equity, private debt, and such. And so employers are going to likely need to hire outside professionals if they're even thinking about adding alternative assets in the plans. And then from a participant standpoint is that, as we know, participants are usually not investment experts, and we don't expect them to be investment experts. And I think that's the reason why target date funds are so popular, because they understand that. And so if it's true that participants either don't have the ability to evaluate investments, or maybe they have the ability, they just don't have the willingness. I don't want to spend my time doing this, and so they have troubles, difficulty sometimes understanding publicly traded mutual funds. I'm going to suggest that that is going to be compounded if we're going to introduce alternative assets in our plans. So that said, industry reaction to the proposed rule has largely been very positive. Again, it standardizes, formalizes what fiduciaries have always been required to do. It takes an asset neutral approach. We're not saying you need to put alternative assets in your plan. We're just saying whatever investments you think are appropriate for your plan, you evaluate them in a prudent manner. That said, there are some concerns. Again, the Department of Labor poses this as a safe harbor rule, but there is no real guarantee that courts are going to defer to a fiduciary's decision, even if the fiduciary follows those regulations, right? So I'm a fiduciary. I go through all 6 factors before I decide I'm going to offer this investment inside of our plan. I get sued. I can just say, hey, court, guess what? I followed the factors. You can't touch me. I would be surprised if that occurs. Again, it's not a true safe harbor, it's a presumption. And especially with recent developments in the last couple of years at the Supreme Court, it's not entirely clear to me what type of deference courts are going to give a fiduciary, even if the fiduciary follows the safe harbor rule. Again, it might all work out. I'm just saying is that only time will tell, and this is a concern. Now, that's not a reason not to follow the proposed rule. I'm just saying is I don't think there's as much of a guarantee that courts are going to provide significant deference to fiduciaries that the DOL hopes. I mean, I hope the DOL is right, but I'm not convinced, and we'll have to wait and see. The next concern is that a lot of times with rules these days, a final rule gets issued and there's an immediate lawsuit somewhere in the country, some group or a couple of groups seeking to invalidate that rule. And so a court puts an injunction on and says, this rule is not in play until we decide whether it's a valid rule or not. I wouldn't be at all surprised because this is a big rule that someone somewhere initiates litigation seeking to invalidate a final rule. We'll have to wait and see. Another concern is, yes, this does a real nice job, this proposed rule of standardizing and formalizing what fiduciaries should do. But the concern is this really just become a checklist that plaintiffs' lawyers can use to initiate litigation? Well, I mean, I think they're going to. And in fact, the pioneer in 401k plan litigation has already done some interviews suggesting that a fiduciary that allows alternative assets in the plan will be the ground for litigation. And so we'll have to wait and see on that. And then finally, the concern is, touched on it, is how do we educate our participants with respect to private equities that they can't look up every day and get a value every day, or they might not even have a complete grasp of what's in their mutual fund investment. So should we add alternative assets to our 401k plans? Well, there are two sides to this issue. The first argument is, yeah, we should add alternative assets to a 401k plan. And this is really the point of the presidential executive order, which says that, private equity, for example, has only really been available to high net worth individuals or high income individuals. And if we allow alternative assets in our 401k plans, that's going to allow for a larger portion of our population to invest in these alternative assets, thus democratizing access to alternative assets and to allow for potentially higher returns and better asset diversification. So that's the argument for adding that alternative assets into our plan, and that's the position that the administration takes. The argument for against adding alternative assets to our plan is that this is really just a ploy for private equity managers to get access to another market with a couple trillions of dollars in the 401k market. Now, there's never been a rule prohibiting alternative assets in a 401k plan. They've always been allowed as long as a fiduciary prudently evaluates whether it's appropriate to have alternative assets in our plan. But why hasn't these alternative assets been our 401k plans? Well, the administration says that it's because our current litigation environment has had actually an effect on fiduciaries who are afraid to put alternative assets into our plan. But the argument against it is, look, there's liquidity issues, valuation issues, higher fees, and complexity. Look at that. Those are 4 of our 6 factors. And the fact that private equity investments, alternative assets are opaque in nature, the argument against is that adding alternative assets don't justify adding potentially riskier assets into our plans, especially, especially in a litigious environment. So if you are seriously considering adding alternative assets into your plan, my recommendation personally is let's just wait and see what happens. Let's wait until a final rule is issued. It may be different than the proposed rule, though I think it's going to be largely the same and they may expand in some specific areas. But let's wait and see what the final rule says. It also remains to be seen is how alternative assets are going to find their way into our 401k plans. There has been some talk about standalone private equity funds inside of 401k plans. I don't think that's going to be widespread at first. I think it's much more likely that alternative assets are going to find their way to 401k plans through target date funds. Our target date funds may have a alternative assets component to it and also managed account services where our managed account service actually has an alternative assets component to that. And so I think if alternative assets are going to get inside of 401k plans, I think it's going to be through target date funds and or managed account services. But again, let's wait and see how this unfolds over time. And so I would encourage you, if you are seriously considering adding alternative assets to the plan, is do talk to your Union Bank relationship manager. What's next from a Department of Labor perspective? Well, they have 45,000 plus comments on the proposed rule. The Department of Labor is reviewing those comments after it goes through the Office of Management and Budget process for review. We may get a final rule in fourth quarter 2026. Depending on those comments and how long it takes to go through, it might be a little bit later than that. But people are thinking we may get a rule by the end of the year. From Union Bank's perspective, we're kind of wait and see. We're going to see what the final rule says, and then we will no doubt revise our investment policy statements to incorporate terms of the final rule. So that's all. Well, there is my investment policy statement. Like I said, we're going to take a look at the investment policy statements and see how the current statements sync up with the final rule. But again, I think the big takeaway here is let's just wait and see before we start adding alternative assets into our plan. Let's at least wait to see what a final rule says. So with that, that's the end of my prepared remarks. I'll be glad to take any questions. Alternatively, if you're more comfortable doing so, here's my contact information. You can always call me. You can always email me at any time if you've got any questions about this topic or any other topics with respect to your retirement plan. So I appreciate you joining us today, Jason.
Yeah, thanks, John. That's a lot of great information. Obviously, it's as you do a great job of taking a complex topic and making it much easier to understand. And again, like John said, thank you everybody for joining. We are right up against the 11 o'clock hour. But if you have any questions, please just let us know right now. And, we have about a minute or so to take a question or two if you have it. If not, we will let you go. You can always unmute yourself too and ask the question. Okay, and I don't have anything in the chat box. So again, we really appreciate you all joining today. And like I said at the very beginning, this is a recorded webinar, and thankfully it is, because I think this may be some information you may want to go over again. In any case, we're going to let you all go. So thank you for joining and take care.